So my name is Szabolcs Szalay. I'm a senior advisor at BCG and a visiting lecturer at CEU. And let me talk a couple of words about the past of banking before I'm turning to the future of banking. So being a banking client is a good thing. Being a bank robber is an even better thing. Being a bank shareholder, it's a not so good thing in the past 10 years since the global financial crisis. Banks were underperforming the benchmark, let's say, seriously, both in Europe, in the States, and in Asia. If we are looking the global picture, 2/3 of the banks are traded below book value. So it's not a great business. The sum of the parts is less than one. And there are obviously regional differences. The worst is Europe, China, and Japan. US and South America is roughly at average. Where you see the high growth region where it's better to be a banker shareholder is the Middle East and Southeast Asia. And from the Western world, Canada is standing out, where most of the banks are trading above book value. If we are deep diving a bit, the bad news for banks, especially the ones which were trading below book, that their financing role in the economy is diminishing. The alternative universe of investment banks, mutual funds, private credit, private equity is gaining traction across the globe, especially in capital financing, capital market financing, and large deals. Banks are more and more financing traditionally the private individuals and small and medium-sized enterprises. And it's even truer in the high growth economies. In the high growth economies, the alternative financing venues are gaining traction against the banks. So this is the past. In the past 10 years, it's not been a great position. Obviously, there were differences. There are some banks which were generating a lot of great return, but the general picture was a bit bleak. Is the future brighter? I would argue that there are three things which are pressurizing the banks. On the one hand, the emerging fintech challengers and fintech and big tech, and we can talk about both, that they are putting a pressure on the revenue pools and the margin of the banks. Second, the regulatory pressure. We heard about MiCA, DORA, and all the names in the dictionary, and all of these are different kind of regulations which put a pressure on both the capital of the banks, which is good for the society. Even in today's turbulent times, the cushion of the bank's equity is much better than in the financial crisis, so they are more stable. But from an ROE perspective, once you increase the equity and you reduce the top line, the return on equity doesn't look great. Hence, the profitability of the banks are under pressure. And the third element is the cross pressure, both from regulations, from digitization. So the banking is becoming a scale game because you have to be compliant with everything. You have to digitize, you have to make AI, you have to make everything. But it's the same, let's say, fixed cost for most of the players with a very little variable cost. So the bigger you are, the better you are off. But these things showing that the banks are not much better shape, or we don't expect them to be a much better shape in the coming years. And I was talking about traditional banks. If you are looking at fintechs, the picture is somewhat different. There are roughly more than 450 neobanks in the world today. Out of those 450, roughly 20 is profitable, which doesn't mean that the other 430 is not attacking your revenue pools. These guys are providing services for free, account for free, debit card for free, everything for free. They are free of profit, obviously. But it doesn't help the banks because they have to be on the stock market, and every quarter they have to show a positive value. So this is a pressure from the fintech world. There is a difference between, let's say, Europe and the Americas and Asia in the fintech and neobank domains. In Europe and the America and South America, these are practically startup neobanks. Like the biggest ones you heard, Revolut has bypassed like 50 million clients. Nubank has like 120 million clients in South America. They are the biggest ones. Their market shares in deposits and loans is minuscule vis-a-vis the traditional bank. In lending, even the biggest market share of neobanks is somewhere in the low single digits. In deposits, they can be up to 10%, but typically less. On the other hand, if you are going to Far East and Asia and China, there you see not like standalone neobanks as a competition force. There you are competing with these super apps. Like WeChat and Alipay both has 1.3 billion clients. The people in Southeast and Asia and Far East Asia, they are living their life in their app. They are shopping, they are entertaining, and they are doing their finances in these apps, where banks are, even if they are standing behind, they are becoming a utility. They are a balance sheet provider. They are not owning the customer relationship anymore. So it's a huge threat to the banks, and that's why we've seen that the banking sector in China, among other things, why they are kind of losing this game vis-a-vis the fintechs. And it's not just China. If you look at Gojek or Grab in Indonesia, they have roughly 200 million clients. So even the biggest European neobank, Revolut, with 50 million, is pale in comparison with these guys. So this is a huge pressure from the fintech world. And there are other fintechs which we don't consider fintechs typically. Apple might be the biggest fintech of the world. They started with Apple Pay, but they moved to deposits. Then they went to credit card. Now they are offering with iDen buy no pay later products, and they are again owning the customer relationship. They are attacking the banks. The banks want to own the customers. The banks are striving for primary customers. But the Apples and the Amazons of the world are taking this over. And what would happen if they are succeeding with Apple Intelligence and Siri becomes my personal CFO? I might trust better Siri than my local bank in Austria or Hungary or wherever I am. So big tech is also a bit of a threat. But big tech don't want to be a bank. Why? Because of regulation. I mean, they are smarter than that. If you are looking the global regulatory landscape, and we heard regulations is positive in terms of MiCA and DORA, but global banks have to meet every year couple of hundreds, up to 1,000 regulation. So it means like 3-4 regulations per day. And these 3-4 regulations per day, you have to fulfill, and fulfilling these regulations is something like a 1 to 2 year long IT project in any given bank, impacting hundreds of systems and and many departments. So being compliant is not a cheap thing. Being non-compliant, it's even more expensive. So the fines, about in the range of couple of billions of USDs, is critical for the big banks, but not just for big banks. If you think of N26 between 2021 and 2024, by BaFin, the German regulator, they were capped how many new customers they can gain because they were non-compliant with a couple of rules. Once they became compliant, after spending a bit more than 100 million euro, their intake of new customers doubled and they became profitable in the next quarters. So compliance is a pressure for both banks and even for the fintechs, because fintechs, when they start their journey, they start with a couple of smart guys who are developers. They think that they can change the world, and then BaFin and the other regulators slash their face, and then they hire as much as compliance officers and regulators and developers, so to be in the same ballpark. But overall, for the society, regulation is good. For the banks, regulation is hard, and it's also shown in their IT spending. Banks are one of the biggest IT spenders among all the industries. A typical bank is spending 10% of its revenue on IT. But it doesn't reflect that banks are not the most innovative IT spenders. So if you have to call who are the biggest innovators, you might not call banks. From this 10%, more than half is going to run the shop, which is very important, and running the shop is expensive. Why? Because it's standing on a legacy technology stack. More than 40% of the total financial services code base is still based on COBOL. There are some elder guys in the room who might heard this programming language. Is invented in the 1960s. Most of the guys who were able to program COBOL either died or retired long ago. But banks are pretty hardly touch these systems because actually it works. Second, they don't know what is inside. One of the great AI developments, and there are a lot of experimentation, that with the help of LLMs, who are becoming good at coding, first in Python, because this is a new language as in GitHub and not the COBOL code, but they try to reverse engineer what is the COBOL code because it was easy to read in English, and change the COBOL code to something Java or something like that without destructing the system. Besides running the show, there is this 15-20% for regulatory compliance. So for innovation, for true innovation, you have like 1/4, or if you are a super smart bank, 1/3 of your total IT spend is going to innovation. And looking for the future, I would like to highlight 4 types of innovations banks are going to spend a lot on. First is continuing the digitization. Second is embedded finance. Third, the new type of money and tokenization, what we heard about. And fourth is obviously AI. Let's deep dive into that. If you look at the digital excellence, like banks were introducing mobile phones, they were smart to push all the cashier transactions, the like inquiries from the branches. The second wave is putting the sales into the mobile, putting sales outside of the branch, even for complex products. There is a difference. The graph shows roughly similar size of retail banking clientele with 4 to 5 million clients each. And you can see that it's from 4,000 to 1,200 the size of the people pool or this stuff. It makes a huge difference on the cost structure, whether one people is servicing in theory 300 to 400 clients or 1,000 to 1,200 clients. For comparison, the 50 million clients of Revolut is being serviced by 11,000 people. So their, let's say, employee to client ratio is above 3,500. Obviously, their product range is not as big as the traditional bank. But if you look at traditional banks who are going to the branch, you can look, for example, the example of ING in the Netherlands. ING in the Netherlands 10 years ago, in 2015, they started from 260 branches. Today, they have 40. People in the Netherlands are really keen to buy things on mobile and are really unkeen to go to the branch anymore. So, and this shows like a big shift. If we are looking the graph behind, the global average, and this is a BCG study involving more than 400 banks and their mobile applications, we compared the feature set. And the 100 points could be like if you have a mobile app with all the features of the world, which actually doesn't exist anywhere. So the global leaders at the average of 60 something. The global average is 30. So 2 things I would like to highlight. The most advanced digital applications are not coming from the traditional financial centers. It's not from London, not from New York. This is the Asian super apps, this is Poland, this is Turkey, where the banks are innovating much heavier than in the traditional banking centers. The good news for the banks that even if you are at the average, like the global average at 32 point, it was 1 year ago, with an 18 to 24 months advancement, you can increase to 45, 50. So it's not an impossible journey, but this still shows that most of the banks still have to invest in digitization. You feel the difference using mobile app of X or Y, that this is faster, this is nicer, this has a bit more feature than that. But if we are talking not about the mobile app of the bank, what we see that with open banking, what Ivo will address, and embedded finance, we have to get closer to the customers on the one hand. So banks try to improve the experience of the mobile banking, but the real experience is not coming inside the banking app. The real experience is coming when you are shopping. How much it's easier to sit into an Uber and you don't have to deal with the payments. If you are sitting in a normal cab, at the end of the journey, you see the taxometer. If you are in Hungary, you don't see the taxometer, and you were told how much is it. In Uber, like you sit in, they know what is your starting position, they measure what was your travel journey, and they automatically credit your account balance. You don't have to do anything. If you are buying something on eBay or on Amazon or whatsoever, you have a one-click payment. Actually, with Klarna or IDEN, you could have an instant loan with one click or free for installments, which increases the likelihood of buying. In insurance, if you are buying a plane ticket, you tick one and then you get the travel insurance. Actually, if you are flying with Ryanair, you have to tick 3 to not to get the travel insurance. So this is a different story. But this, from the online world, we are moving to the real world. So the grocery example, there is a smart Samsung fridge, and if it feels that it's out of stock of your favorite food, then it already gives you an opportunity on the touchscreen to reorder and replenish your supply and makes the payment beforehand. Like with Instacart, they are integrated through APIs. And if I'm thinking further, we were talking about AI agents. It's not that far that the fridge doesn't even ask me what do I have to replenish, because it knows what are my preferences and goes for a deal. I try to avoid the fact that my fridge is going for a deal and looking around, and the AI agent is shopping around that where is the discount in Aldi or Lidl or Tesco, and goes to the cheaper place to get my favorite beer. Until that point, I'm fine with the agent. The problem starts when my smart agent saves, let's say, 10 euros on my last purchase and trying to invest in a smart way because it thinks it can double my monthly replenishment budget. So that one I'm not that trusty that far for AI agents, but this is coming. So embedded finance, go where the clients are, make it easy, make it fast, and I mean, nobody gets up, oh, this is a great day for banking. I have to make 5 transfers today. I mean, banking is a hassle. Banking is not joy. Shopping is joy for many of, not me, but for most of the society. And this embedded finance landscape, even without the AI agent story, is gonna be huge. By 2030, we expect it's over 300 billion. And so far I was talking about consumer practices, but it's also impacting SMEs, like small enterprises. Let's imagine, for example, a restaurant software, which is primarily responsible, the basic feature is farm to table, to manage the source, and then at the end you have the nice food. But in the meantime, it can manage the payment, it can even have the cash flow projection plan based on the restaurant occupation rate, and if it's needed, it can offer you and provide you an instant loan without stepping out from your restaurant management software. So this is the embedded finance in a small and medium-sized enterprise, and for the same supply chain goes for large enterprises. So this is one thing, get closer to the customer, get closer to the real-life journeys, and make the finance seamless. The other, we heard about tokenization, kind of finally we might be in an age of real internet money, and it's a different thing. It's not the counter movement of the bitcoins, let's kill the banks. Like all the players are asking for regulators to support them. And CBDC, central bank digital currency, it's not a success story so far, but like 9 out of 10 central banks are experimenting with it and thinking of it. Why? They got upset when Meta, then Facebook, introduced Libra, a stable coin, and they felt that, oh shit, the monetary policy is out of our hand. And then they see, there are stable coins. Stable coins is simply the primary killer app of the blockchain technology. Blockchain technology is there for 2 decades. Stable coins finally showed that for emerging economies where the volatility of the local currency is pretty high, stable coins are the means of exchange, and getting more and more the means of exchange instead of Bitcoin. It's still important that there is a conversion to fiat currencies. But CBDC, stable coins, tokenization, these are going hand in hand. And what's happening that these new form of payments or new forms of instruments are providing something which neither cash nor the current electronic money system can provide. It can provide instant settlement. Instant settlement works domestically in many countries. Instant settlement across the globe doesn't really work. It's still SWIFT, correspondent banking, T+1, delay, card networks, and it works not only for cash or cash equivalents, but it would also work for different kind of currencies. So I tend to disagree with the colleague that like tokenization is for decentralization only. Tokenization could also be a big cost saving for banks because they can save a lot of reconciliation step, and in account and settlement of securities transactions, it's often T+2, sometimes even T+3, and the costly process, so they can save a lot of that. What I expect, and it's a controversial topic, the programmability of money, programmability of stable coins or CBDCs. Central banks are extremely cautious, and they say, we see that there is a programmability feature, but we don't want to live with that, because we want to keep that the money is a universal mean of exchange. It's like cash. We are not forcing anyone to use the money for X, Y, Z, at least in Western economies. In China, with the EU, it's a bit different story. It could be a different story. But programmability might open totally new use cases how we are dealing with money vis-a-vis the classical way. And for traditional banks, like a central bank digital currency, it could be a threat. First, central banks will not serve the customers, so the traditional banks have to bear the cost of technology on one hand. But from an economic perspective, if people are putting their side deposits to a central bank digital currency, it means banks have to go out for the wholesale funding to replace what was there as a kind of very cheap funding on their liability side, which increases the cost. Again, a pressure on profitability. So banks are not extremely happy yet with this CBDC development, because they don't see how they are going to benefit from that and not get the hindsight of these movements. But this tokenization, as we heard, it's increasing. Big players, Templetons, Goldman Sachs, BlackRocks, actually with the support of the regulators, are playing in sandboxes. They are trying out what is happening or what can happen. And the recent BCG study, which we released together with Ripple a couple of days ago, showed that the tokenization market, and it's not meme coins, these are real world assets, gonna be tokenized from the current roughly $500 billion in size, can go up to nearly 20 trillion in 10 years time. So this is a big movement. Finally, the banking technology see the real benefits of blockchain technology in moving real world finance into assets. And yes, it's not a counter movement, it's not about revolution, it's about making money. Wealth managers and financiers and investors are looking ways how to protect their revenue, how they attract new investors who are on-chain investors, and how they reshape their offerings to deal with these new type of assets, new type of movement of money, and new type of settlement methods. And the final talk about AI. I mean, AI in banking is not new. It's a left brain, right brain story. The left brain, the predictive AI is used by banks for 20 plus years. In the credit decision engines, in the fraud, in the AML engines, predictive AI is being used. Enhancing with the new LLM-based generative AI features, it opens up new possibilities across the banking domain. So it's always not just Gen AI, not just an LLM, it's a combination of predictive AI, different language models, the agentic movements, which can bring a lot of use cases and a lot of benefits to banks. Besides the benefits, always there are also risks. The risks not just from, let's say, the fraudulent activities. The bad guys are always smarter to use the new tools. So there are a lot of people who try to hack the bank using LLMs, they are not hacking the banks. Primarily they are hacking you. And primarily they are hacking smart male financially educated people, because smart male financially educated people, according to the study, think that they are smarter than the hackers. And often they are not. Hence, they are falling into the traps of social engineering. Social engineering is the primary hacking tool, and with the use of AI, social engineering is just elevated at the square. but there are risks also inside the models. So we happy to say, yeah, it's a kind of a black box. Sometimes we are looking into the black box. But when you are looking into a black box, what you see is darkness. And this is what we see with the AI. We don't know how they are being built. Even when we call open source AI, it's not open source, it's open weight. We know that what are the weights. We don't know what were the data sources. We don't know whether someone trained the AI that based on a simple English term, or not English, but an SQL term, or a Japanese term, or a Hungarian term, how it's going to behave. So colleagues who are implementing AI solutions, they are saying that, okay, putting an AI in work, it's a very, 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 very long way of testing because we are not sure how they are going to react. And as banking industry, we have to avoid. So everyone in banking thinks that AI is a great next thing, like 85% of the CEOs we were surveying. Currently, less than 20% are comfortable that we are generating revenue out of AI. Where they are, and we are in a wait and see stage. Why is that? I mean, it's a bit of a complicated graph, but the green, or the dark green, shows the banks who are able to scale AI solutions. So it's super easy to run a proof of concept with an AI tool, with an LLM tool. It's super hard to scale it up. In BCG, we used to say it's a 10, 20, 30, no, it's not adding up to 100, 10, 20, 70. 10% is the model, is the machine learning, is the CU science class. 20% is the technology and the data. And 70% is change management. 70% to convince people to use, to teach them how to use, to let them not afraid from the AI solutions, and they have to be focused. The middle part of the graph shows that if you are focusing your efforts to real, truly transformational events, then your outcome and your return on the investment is twice as much when you are spread around and doing a lot of experimentation, because a lot of experimentation is super hard to scale. And if we are looking where banks are actually using, obviously the first use case, as András also mentioned, is the programming, developing world. So the developers, customer engagement and sentiment analysis, but in customers, banks are very cautious to put AI agents or AI-driven chatbots to the public because of the risk we were facing. They are primarily experimenting first in-house. And there are some examples when they are going out for a while, but they are cautious with this approach. The other area of hyper-personalization. But if you pick one of those and you can focus, it can really bring a benefit of in the range of 30 to 40% efficiency increase. And we are not there yet. Like, this is traditional efficiency game. We don't see yet how the AI native companies going to operate. What is an AI native bank? We are not there yet. Traditional banks are reinventing their processes with AI. But reinventing their processes with AI requires real reinvention, because if you have a crappy process and you put an AI on the crappy process, it's still becoming a crappy process. So I want to finish, and this is my personal view, it's nothing to do with BCG. When I was preparing for this workshop 2 days ago, I had a nightmare. My personal banking agent spent all my money from my Bitcoin wallet because it went to the prediction market and thought it's a great idea to bet against Trump's trade policy. I wanted to drink myself to the yellow ground, but my smart fridge, absolutely from ESG reasons, thought that my next 6 packs cannot be ordered. And finally, I got up and get to the train and came here, and thank you for your attention.